Buying a home is one of the biggest financial decisions most people will ever make. And almost no one does it with their own cash. Instead, they use a mortgage. A mortgage is a special kind of loan that turns the dream of owning a home into a reality, but also into a long-term financial commitment. If you understand how it really works, it becomes a tool. If you do not, it can quietly control your life for decades. At its core, a mortgage is a loan used to buy a property, where the property itself is the security for the loan. You pay a portion of the price up front, called the down payment. The bank or lender pays the rest to the seller. You then repay the loan in monthly installments over many years. If you fail to pay, the lender has the legal right to take the property. This matters because most people focus only on the sticker price of a home. But the real cost of buying with a mortgage includes interest paid over many years, taxes, insurance, and maintenance. Over a long loan, the total amount you repay can be much higher than the original price tag of the property. Understanding the full picture changes how you decide what you can truly afford. To understand how it really works, picture three numbers. The principal, which is the amount borrowed. The interest rate, which is the yearly cost of borrowing. And the loan term, which is how many years you take to repay. Each monthly payment is a mix of principal and interest. Early in the loan, most of the payment is interest. Later, most of it is principal. The split shifts slowly over time. Let us look at a simple example. Imagine you borrowed $200,000 at a 6% rate for 30 years. Your monthly payment is roughly $1,200. Over 30 years, you would pay back over $400,000 in total. More than half of that is interest. The same house, the same purchase price, but the long-term cost is dramatically different because of how loans add up. A common mistake is to choose the longest possible loan term just to get a lower monthly payment. Longer loans look more affordable each month, but they quietly add tens of thousands of dollars in extra interest over the life of the loan. The same property can cost two very different amounts depending only on the term you choose. Lower monthly comfort can mean much higher lifetime cost. There is also a hidden risk to taking on too much mortgage. When the monthly payment is too high relative to your income, every small life event becomes stressful. A job loss, a medical issue, or a slow business month can put the entire household at risk. Borrowing the maximum the bank offers is not the same as borrowing what is truly safe. The bank measures eligibility. You must measure comfort. A useful way to picture a mortgage is as a long bridge. The bridge connects you from where you stand now to the home you want to own. Each monthly payment is a step on that bridge. The longer the bridge, the cheaper each step feels, but the longer you have to walk. The shorter the bridge, the harder each step, but the faster you arrive on the other side completely. A second key idea is the difference between fixed and variable rates. A fixed rate stays the same for a defined period, sometimes the entire loan. A variable rate can move up or down depending on market conditions. Fixed rates offer predictability. Variable rates offer the possibility of paying less if rates fall, but also the risk of paying much more if they rise unexpectedly during your term. A practical example helps. Imagine someone chooses a variable rate because it is slightly lower at the start. For a few years, they enjoy small monthly savings. Then rates rise sharply, and their payment grows by hundreds of dollars per month. They are now paying more than the fixed option would have cost from the beginning. Cheaper is not always cheaper when you measure the risk of change. Beginners often misunderstand the role of the down payment. A larger down payment usually means a smaller loan, lower interest paid over time, and better terms. A small down payment can require extra insurance and lead to a higher long-term cost. The temptation is to buy as soon as possible. The smarter question is whether you have enough saved to buy without straining everything else in your life. There is also a psychology angle. A home is emotional. People often stretch their budget because the place feels right, the neighborhood feels safe, or social pressure pushes them. But the same emotions that win the bidding war can later cause stress when the payments arrive. Separating the desire for a home from the math of the loan is one of the most important skills in mortgage decisions. A simple practical rule helps protect your future self. Make sure your monthly mortgage and related housing costs leave room for savings, emergencies, and a normal life. Many people use a rough cap of 1/3 of take-home income, including taxes and insurance. The exact number depends on your situation. The key is leaving breathing room, not maxing out every dollar the bank says you qualify for. There are things to avoid. Do not focus only on the monthly payment. Always look at the total cost of the loan. Do not skip property taxes, insurance, and maintenance from your planning. Do not assume rates will always stay friendly. Do not borrow the maximum just because you qualify. And do not buy a home without an emergency fund in place that can absorb a few months of payments if something goes wrong. A better habit is to think in scenarios, not just averages. Ask yourself what happens if rates rise, if income drops temporarily, or if a major expense appears. A mortgage that survives stress scenarios is a strong one. A mortgage that only works perfectly in the best case is dangerous. Stress testing your own plan is a simple but powerful step that most first-time buyers skip entirely. Over the long term, paying a little extra each month, when possible, can change the math dramatically. Even small additional payments toward the principal can shorten the loan by years and save large amounts in interest. The catch is to confirm with the lender that extra payments go toward principal, not future interest. A small habit, done consistently, can quietly turn a 30-year loan into a 20-year one. So here is the short version. A mortgage is a long-term loan secured by the property itself. The cost depends on the principal, the rate, and the term. The total amount repaid is usually far more than the price of the home. Larger down payments and shorter terms reduce lifetime cost. Fixed rates offer stability. Variable rates offer flexibility with risk. The right structure protects both your home and your peace of mind. If you are planning to buy a home, treat the mortgage as carefully as the property itself. Do not let excitement choose the loan for you. Compare offers from multiple lenders. Run the math on different terms. Build a buffer for unexpected costs. A house is a place to live. A mortgage is a financial structure that surrounds it. Both deserve the same level of attention, and both will shape your life for years.